Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, out to make it actionable, understandable, and clear. What a week. What a show. The leaves are finally falling here in Dallas, Texas. I'm watching them fall right now while we record this. Incredible content for you. Incredible. I want to say this is one of the more polarizing articles I've ever read. Wall Street Journal article, Inside the Invitation-Only Stock Market for the Wealthy. This is by Corey Drybush. I've got some problems with it, but learned a lot from the article. We're then going to look at the forgotten bond market known as municipal bonds and municipal money market funds. I had a very astute client ask, hey, should I be looking at municipal bonds? And yeah, I think a lot of us should. And we're going to dig into that. And then Robert Hunt Financial Nation. We have gotten feedback from our friends at Frost Bank, and they're grateful for all of you that went there. We're going to talk about why objectivity matters so much in the manner in which you receive financial advice. But at the top, Wall Street Journal, December 12th, Inside the Invitation-Only Stock Market for the Wealthy. Subheadline, the buzziest private companies are being sold to a select few as the universe of stocks everyone else can invest in shrinks rapidly. I warned you. I had some problems with this article. I felt like there were some, it was light on data, long on conjecture, long on opinion. This felt more like an opinion hit piece from Ms. Drybush, although I learned a lot. I'm grateful for the article, and it was a very long article, so appreciate journalism. But what's going on here? The article explains this year's largest stock sale wasn't on the New York Stock Exchange or its uptown rival, the NASDAQ. Instead, it was a $40 billion offering by OpenAI that was available only to the investors handpicked by the firm's executive team, including Sam Altman himself. Fewer than 50 investors snagged shares. Now, what's Ms. Drybush already doing? She's trying to communicate to you, the reader, there's this party going on where everybody's getting rich except for you. There's this special place where only special people get to invest, and they're going to make all the money, and you're not. Fuddy-duddy you. You're going to be left out in the cold. I disagree, as you can already tell. The article goes on, and this is interesting data. The number of public companies in the U.S. is half of its peak in the late 90s. She explains that's not a problem for the rich. So she thinks. I disagree again. She says the ultra-wealthy are able to buy and sell shares of the buzziest private companies via invite-only transactions long before they list their shares on public stock exchanges. I need to pause here. What you, the listener, should be asking yourself, you the reader of this article, is, Ms. Drybush makes it sound really important that access is available to these private companies. Now, I'll save you a little bit of the trouble. It's a 6-page article when you print it out. Is there data that shows from Ms. Drybush that investing in these private companies at scale is superior than public markets? No. She offered no such data. What she offered was a lot of opinions about exclusivity. Many things are exclusive and private in our world. Not all of them are beneficial. If you believe that just because it's exclusive and private, it's beneficial, then I could see why you might be angry that there are private companies being sold. But what I suppose, you could have offered me an infinite amount of money to, I could have had an infinite allotment to purchase this OpenAI offering. I would have not bought a nickel of it. There will be lots of these private companies that are worth zero, and it's quite possible OpenAI will be worth zero. Now, that's true of a public company, but OpenAI has significant risk. It loses tremendous sums of money. It has effectively no balance sheet that can handle all of its spending, and it has multitudinal agreements with a whole host of companies that are Swiss cheese agreements. They can be cut through. Their counterparties are stronger than they are financially in many respects. So yeah, you don't get to invest in that. Is that big a deal? Now, she explains, and I thought this is interesting. This is Paul Atkins, the Security and Exchange Commission chairman. He wants more companies to go public, which is great. I'm all for that. They give the example of young companies like Intel and Apple decades ago sold shares to the public to raise money to hire employees, yada, yada, yada. He says the insiders got returns, but the public really shared in those. Now, we know the data, don't we, listener? We know how few of the publicly traded companies actually contribute to the return. 4% of the market contributes to 100% of the return. The rest are just earning the cash returns. So it's going to be tough on the private side to convince me that, oh, you can invest in all these private companies. That's better for you. Well, this article also, I mean, here's another example that I think it could explain in a much better manner. When Figure AI, a San Jose, California company, they make humanoid robots. They raised $675 million last year at a $2.6 billion valuation, a private funding round. Jeff Bezos was among the participants who bought the shares. Early this year, the company reached a $39 billion valuation, a 1,400% increase in less than 2 years. Okay. So what? I still have no data. The cherry picking, I could do that in public data. I could do it with stock market data. I can show you why investing in the stock market is better than private. But you're showing me just I still have no data. And wouldn't you know it, in my practice, I've seen a lot of private investments go to zero. I've never seen an index fund investment go to zero. And it's less likely that a large cap public security will go to zero. It happens, but it's less likely than these private markets. The article continues. It talks a lot about SpaceX, which of course has had a great run. But would I have bought into SpaceX? Would you have, when it was worth $1 billion? Here's this fledgling space company that's losing money all the time and has blow-ups. And Elon Musk himself said if they had not had a successful launch on their third launch attempt, it would have been a zero. I would not have done that. I don't think very many would have. But now everybody wants in. Everybody wants in, and here's this clubby thing that she says, which I disagree with. Yeah, because you can get into SpaceX right now at $800 billion valuation. That does not ensure you'll make money on it. And there are not a ton of protections. The article explains, as it stands now, private companies aren't required to disclose their financials to their investors. I think many do, of course. You'd be crazy not to, but that's not a requirement. Makes me less compelled to invest in these private offerings. And so I think it brings up another learning opportunity. That's right. You're listening to the RHF Market Update, so you know you want to learn. What does it take to get an index? Have you ever thought about that? You have all these companies in an index. What did it take to get there? Is it meritorious that they are in there at all? Or do they just kind of shove a bunch of names in and hope the index does well? No. We'll look at the most famous index, the S&P 500. It's managed by the S&P Dow Jones Indices Index Committee. I would love to be on that committee. If you're listening, that'd be fun. There's a threshold today. This is as of July 1, 2025. A company must have an unadjusted market cap of $22.7 billion. You got to be pretty big to be in the S&P 500. And this, 80% of VTI, which is Vanguard's total market, it's basically the S&P 500. So I chose this one. Additionally, the company's public float, shares available to trade, must be at least 50% of that threshold. So you got to have a lot of shares available. This is a good one. Profitability. The sum of the most recent 4 consecutive quarters of earnings must be positive. The most recent quarter must also be positive. You got to make money to be in the index. You got to have trading volume. You got to be domiciled in the U.S. You've got to be on an exchange. It must be listed on eligible U.S. exchange, which has more rules and regs. New York Stock Exchange, NASDAQ. Only common stocks and REITs are eligible. You can't be a limited partnership. You can't be a master limited partnership. You can't be a business development company. So it takes a lot to make it in the index. And oh, by the way, once all that's done, did you know there's still a committee? It's like the college football playoff. There's still some subjectivity here. If you want to get in, they prioritize sector balance. which means if they think there's too much tech in there and it's a tie between tech and a qualified industrial healthcare company, they're going to look to put the industrial healthcare company in there. So a little bit of human influence, but not a lot. You got to, it's a lot of rules. It's 500 companies. It's a lot of protections for you, the investor. Now, I'll confess, I think there is some risk that the SEC or others would make it so difficult to be public, stay public from a cost standpoint. And I hear this from time to time, that people would want to go private. Yeah, I think they should work on that. I think we should have lots of public companies. I think it's good for America. It's good for investors to have lots of choices. Hopefully it's good for companies, that it's a superior structure for them so that their early employees can sell without going. This article explains all these opaque markets with markups. And if you're an early, I think they gave an example of Anduril, the defense company Palmer Luckey runs. There's an early employee that wanted to sell their shares, and so they formed what's called a special purpose vehicle, and special purpose vehicle forms another special purpose vehicle, and there were layers of fees on each one, and investors could buy into it. It was a mess. So perhaps if they made going public easier, people would go public earlier. I think that'd be all to the good. But do not worry when you read articles like this about some velvet rope that you can't get behind, that it's keeping you poor, which is how I'd summarize this article, which I think is a ridiculous thing. I actually believe the inverse. I'm of the mindset that, boy, I'm glad they don't just let a free-for-all happen in these private companies that don't disclose financials and aren't profitable. And as you know, very few of them will actually make it. And you've got to bet on a ton of them in order to make money, which is kind of the venture capital model. But that's all I have to say about that. So be content, listener, with your index fund. The grass is not greener, despite what the Wall Street Journal might tell you from time to time. Now we get into municipal bonds. I had an astute client question, hey, look, got this cash position. Should I be looking at municipals? Yes, was the answer. Yes, was the answer. And I think municipal bonds are bonds that municipalities, right? Cities, government entities will put out that the interest from those bonds is not taxable. Now, in a state like Texas, none of them are taxable, okay, because we don't have a state income tax. There are other states where it behooves you to have municipals from your state to avoid any sort of state income tax. But in Texas, we don't have that. So we're going to put our thinking caps on here, and you can do it. You're a smart listener base. I know this. What you want to decide is what's the best tax equivalent yield from my money. Now, that may be a word you haven't heard before, tax equivalent yield. Now, what's yield? Yield is what sort of income do I receive on my investment? So if I have $100 and I get a 10% yield, that's $10. Is my yield, my interest. Well, in the money market fund at Vanguard, in their regular default fund, VMFXX, they have a SEC yield. Their yield is 3.72%. So if you give $100, then per year you get $3.72. But you got to tax it. Okay, this is where what's called tax equivalent yield comes in. Because did you know, listener, there is a Vanguard Municipal Money Market Fund, VMSXX, that you are unable to make your default. So I asked the Gemini machine, the AI machine, I said, can you do this as a default? No, you cannot. Doesn't let you do it. But municipals have they come in and out of favor. There 2 or 3 years ago, no matter what your tax bracket was, VMFXX, the taxable, was superior. But the tax equivalent means I want to know, what is my VMFXX yield after tax? Because my municipal yield right now is 3%, 3.01% is my municipal money market fund yield. My taxable is 3.72%. What that means, listener, is if you're in the very top tax bracket, your tax equivalent yield for these municipals, 5.08%, which means that is higher than 3.72%, which means it would benefit you to use the Vanguard Municipal Money Market Fund. Now, I'm okay if someone just says, Robert, don't want to think about it, want to keep it simple, you won't hear a gripe from me. But I think for me as an advisor and for you as a listener, we need to be thinking, yeah, but at some point that number gets big enough where it is material. A lot of times it's not. It's not going to move the needle and I'm fine. Hey, stay in the default. It's still a great fund. But the spread's getting pretty big there. So if you've got significant funds, you're starting to look at over 1% difference, 1.3%. That's something. And now what's tough is it doesn't always stay this way. Municipals will come in and out of favor. There are times when interest rates get low and there's no difference, but as interest rates grew, that spread happens. So there's a whole host of exchange trade funds that do municipal bonds that are short term that Vanguard has that are great. You'll just want to look for something called duration risk, which is the longer dated the bond, the more risk that is implicit if interest rates rise or fall. There's more volatility in your holdings. So just be looking at the duration risk. Find an hourly financial advisor to help you think through that. And then in closing, RHF Nation, as you know, I've been pumping this Frost mortgage pricing for no other reason than it's cheaper than anything I've found. As much as I know people that work at Frost and think it's a fine place, I actually don't have any partiality towards it. The day its rates are higher than the competition, I probably won't speak their name again, despite my affinity for the institution and the people that work there. They were gracious enough of you, who listeners of the podcast or clients of mine. The Dallas regional head called me. I didn't answer. Went to the voicemail. I called him back. Maybe I'll talk to him. I'm going to ask him, how's your pricing so low? He said, thanks for all the people you've sent. Now, I don't know how many total I've sent. I know minimum how many have gone, and it's a decent number, but I know with the podcast people listen and do things. I have no idea if they do them. One thing to remember, listener, is that I don't get paid a nickel from Frost for recommending them, and that's very important for you. The day I take money from a financial institution and start promoting their products will be the day you lose objectivity. You're now in the sales cycle, which is unfortunately where I would say most financial advice lives, in some sort of a sales cycle. There are different degrees of that cycle, and but you're there, you're in it. So what was it? The latest rate for this week. People give me feedback when they go, hey, I went to Frost. I got I think a 4.75 on a 7-year ARM was the last price number I got. And they're giving out different numbers. Everybody's got a different credit score, and Frost is doing their own, this is their own money. So they're just cutting deals as they can, but it's a good deal. You should go check it out. And don't forget the most important thing to check out, which is keeping those costs low, investing simple, and time horizon long, because that is what's going to give you the best shot on your investing journey until next week, or maybe not, because we're just so close to Christmas. I'll see.